Hello and welcome everyone to this webinar about making tax digital. By way of an introduction, obviously, sorry for those that have signed in to see Diane Lewis. I'm clearly not Diane Lewis. Due to personal circumstances, she couldn't do the webinar, so I've stood in her place. By way of an introduction, my name's Andrew Knott. I'm a tax director here at Bevan Buckland, been here 5 years, and I head up the Cowbridge office of Bevan Buckland. I'm also joined by Isobel Morgan. She's an associate tax executive here at Bevan Buckland, been with us 4 years now, and also sits with me in Cowbridge, and she's ATT and CTA qualified. So just to move on around making tax digital for income tax. There we go. So first of all, what is making tax digital for income tax? So this is the biggest change in the self-assessment regime in 30 years. I wasn't doing tax 30 years ago, but I've been told it's the biggest change in 30 years. HMRC want to change the paper-based process at the moment with digital methods, with the aim of making tax administration more effective and efficient. The revenue has said the key reasons for the changes are hoping to reduce error making. They want to, hopefully by bringing in this quarterly process, we'll come on the slides about the process, but they want to mitigate errors as much as they can. They want to ensure that there's up-to-date records, and this will help with business planning. But if you're reporting your income quarterly, you're not leaving it to the last minute. So it's improving that record keeping and the accuracy of the information. The revenue internally at the moment, they've got lots of systems that don't talk to each other. You've got pay-as-you-earn, you've got self-assessment, these various systems. So one thing they're doing, I believe, is trying to bring together one big system within the revenue, and making tax digital is part of that, and it all feeds information in and information comes out of it. So it's all part of it, the revenue systems equally. And they also want to make sure that everyone pays the correct amount of tax. So they're hoping that with this making tax digital regime coming in, that the correct amount of tax is the correct amount of income really, and profits is being reported, and then the correct amount of tax is being paid. We've seen it with the VAT system when that came into the digital regime, and the revenue hoping is similar with the self-assessment. A little bit about the history of making tax digital before we kind of get into how it works. Making tax digital was first announced in 2015 by the government as a transformation of the tax system. The self-assessment side was meant to be implemented, I believe, in 2020 initially, but that's been pushed back for a number of years. And we're now at 2026 is where the revenue are implementing this system. So I think a lot of advisors were maybe hoping that it was going to get pushed back again. That isn't the case, it's happening. So we now need to look at the process that we need to follow in order to fit with the new regime. With making tax digital for VAT, that was introduced in 2019, and that's still ongoing now with digital reporting of VAT. You've also got corporation tax. The revenue we're going to bring in making tax digital for corporation tax, but they said in the summer of this year that that's no longer going to go ahead. Whether 10 years time that comes back into play, but at the moment it's been said that they're not going to bring in corporation tax making tax digital. So it's probably on to who's it affect next. So Isobel, do you want to go on that?
So MTD for income tax self-assessment, or MTD ITSA as you'll see it known online, is coming into effect for individuals with business or so that's sole trade income or rental income. So it's landlords and sole traders that will be affected by this change. If you're in pay-as-you-earn, you've got a bit of investment income, you're a member of a partnership, or you run your trade for a limited company, this doesn't affect you at this time. So it's only if you are a sole trader or a rental landlord that you'll know that, because you'll be submitting those sole trade and rental pages on your self-assessment tax return. What HMRC want is for you to keep records, digitally, and submit them in a more regular interval. What they're asking is that this is done on software that is compatible with MTD, and it's a quarterly update submitted to HMRC with a final declaration at the year end to finalise your tax position. Now, although it is going to affect sole traders and landlords, it's not going to affect everyone at the same time. HMRC are easing us in.
I should say on that point, with Izzy's already mentioned it, but partnerships doesn't come into this regime. That we see lots of LLPs. That's a partnership as well. So LLPs don't come into this regime. We also talk about proper partnerships where you complete a partnership tax return. So some clients might say, oh, I'm in a partnership, but really it's a rental property that's split 50-50 on the tax return on each party. That's not a proper partnership. We may not do a partnership tax return, and therefore, there's some quirky things around that we need to think about the terminology that we use. Trusts and estates don't come into this making tax digital regime either. So, also we've got sole traders in a limited company, like Izzy said. Some people might say, I'm a sole trader, but I got a limited company. Because it's in a limited company, you don't fall within this. You're not technically a sole trader on your self-assessment return. You've got a limited company. So there's lots of differences where you might fall into the net or you might not.
Exactly. So for those that do, and that would be your sole traders and rental landlords, you will be brought in slowly. HMRC are easing us into this one, thankfully, because as Andrew said, it's a big old change. And MTD is already in existence, I must add. So MTD started in April of this year, April 2025, with the beta testing year. Those with tax agents were able to go in early, have a go, play around with the system, see what it looked like, with the bonus that you wouldn't be issued any penalties if you got it wrong. However, from April 2026, the first round of individuals will be mandated in. So that is going to include those sole traders and rental landlords with gross total income over £50,000. Now, this is your gross income, not your profit. So it's not your income after expenses. It's just the total number of sales or rent received. And it's combined. So if you've got a sole trade and a rental business, it's combining both of those together. So if you've got £30,000 turnover in your sole trade and £30,000 of rental income, you will be mandated on the basis your total is over 60. So it's over 50, it's £60,000. HMRC will then reduce this threshold to £30,000 from April 2027, and it reduces again then in April 2028 to £20,000. So by April 2028, a fair few people are now going to be mandated into the system who are sole traders and landlords, because their income will likely be over that £20,000 threshold.
Yeah, and just to reiterate on that point, it's the gross income. So where we see it quite a lot, someone might have a letting agent that manages the property. Let's say the rental income is £1,000 and the letting agent fee is £100 a month and they get £900 in their bank. We look at the £1,000 when we're looking at this 50,000, 30,000 level, not the amount that's necessarily received into the bank. Similar for people in the construction industry, typically builders, subcontractors. If, say, for example, they do work and get paid £1,000 with £200 deducted at source, we still look at £1,000 when we look at these benchmark testing. With that, if you are VAT registered sole trader, let's say, and you invoice £1,000 plus VAT, we're looking at the £1,000, not the 1,200 necessarily is what's going into your bank. We look at the £1,000 when we're looking at these points. With the turnover, with the points, say 50,000, what happens is we look at the year before. So this is 26, 27, so the 24, 25 tax return that we're completing now, you look at the turnover on that and you look to see if you meet that criteria. I should also add that you only look at the sole trade and rental property, like Izzy said. You don't look at pay as you earn. So if you've got a salary of £30,000 and you've got rental of 25,000, you don't fall in this first year on 1st of April 26, because you exclude kind of the pay as you earn income. You only look at the gross income from your sole trade and from your rental property business. We should also say that when we talk about rental property business, you've got a couple of streams. You've got your UK rental property business. You've also got a stream of your foreign rental property business if you have foreign property that you let out. These are different streams. We'll come on to that a little bit later, but you need to kind of amalgamate the two when you're looking at these limits. And there's no difference on whether it's commercial or residential property. It's all rental property income, hence looking at this. There are some nuances about rent and room relief. If you receive a small amount of income, you don't include it in looking at these. There's a couple of little quirky things, but that's generally it. You've also got to consider increases in, cessation of trade or decreases in the profit. Take an example, 24-25, I might have a client that's got income of £60,000 sole trade. He had a really good year, and he's going to have £10,000 of gross income for the next few years. So this client is over the 50,000, so gets bought into MTD from the 1st of April 26. We know his income's only going to be his gross income's going to be £10,000 for the next few years, but he still gets bought into this regime, and he's got to have 3 consecutive years where he's underneath the threshold in order to then drop out of MTD. So it's not a case of us going to the revenue, their turnover's dropped, they shouldn't be in there. They've got to wait 3 years effectively of doing making tax digital before they can get out of that process. It's slightly different if they cease sole trade. So let's say they ceased, they don't have to carry on doing nil returns effectively for 3 years. They cease, they notify the revenue, they do the final digital assessment, which will come on to on a later slide. And at that point, they then come out to the regime because that sole trade has ceased in that example.
So evidently, this is a big change, and HMRC recognise that there are some people that will need to be exempt. And so we will just touch on a few of the exemptions. A few of them are on screen. There are a number of automatic exemptions. Those without a national insurance number at 31st January will not be mandated. Trustees and executors of estates, but also if you have foster care income, for example, this does not count towards your gross income. So if that were to be the pointer that put you over that threshold, we would ignore it. Same with the rental relief you've already mentioned. There are further applications for exemptions that can be made, but these are not automatic, and you will have to ask HMRC for their approval. These would be the digital exclusion, whether that be you're a member of a certain religious society or it's not reasonably practical due to your age or disability. If you're a power of attorney for somebody or for any other reason, and Andrew will caveat that in a moment, you can apply to HMRC for an exemption from entering MTD, but you will need their approval before you don't enter the scheme.
And I believe the revenue have to come back to you with their approval or dismissal within 28 days of that application. It's what I've also seen. On the required by application, you can see it's location or other reason. So other reason is quite open. I think it's interesting to see what the revenue will actually take from other reason, whether they're, if someone's got a justifiable reason, whether they're going to allow it or say, no, actually, this doesn't fit, you've still got to do MTD. So that's something that we're going to have to see, as time goes on, who's in and who's out and who can really apply not to be in it. But I think the main message is, if it's, clear not a religious society or any other points or location where, say, you don't have internet, those are the key factors that bring you out by an application. So that application needs to be made. You also need to consider doing the application before the tax year upon which MTD applies. You can't wait really until you're in the tax year and then apply. You've got to do it really before the tax year to say, can I have this this exemption? I have seen that if you've got an exemption for VAT, let's say you're sole trade, you're VAT registered, you've got the exemption for VAT MTD, then you don't need to reapply for the Making Tax Digital ITSA exemption. It kind of follows through, but these things are all kind of quite new, so wait to see how it works in process. On the automatic as well, under the current Parliament, they've said that ministers of religion, Lloyd's underwriters, anyone in receipt of the blind person's allowance and the married couple's allowance don't need are kind of exempt as well from this Making Tax Digital. I should add, married couple's allowance is quite rare nowadays. So a lot of our clients may have seen the marriage allowance, which is where you've got the couple, the married couple or civil partnership, one person has a low income and one person's basic rate, and you can transfer the personal allowances. That's not it. The married couple's allowance is if one of the couple were born before 1935. So it's something you don't see as often nowadays when doing tax returns.
So if maybe listening now and thinking, okay, this does apply to me, so how does it work? If you have been watching so far and you think that this now applies to you, this is how it's going to work. So it's a quarterly system. So HMRC are asking for 4 quarterly updates throughout the tax year. These quarterly updates align with the tax year. So they begin the 6th of April, the first one ending the 5th of July, and so on until the 5th of April. These are due by the 7th of the month following. Again, those in the VAT system will recognise these deadlines if your quarters do align with the tax year, which gives us a month and 2 days to get these submissions in. So there is a short turnaround in that to consider. What you do on this quarterly update is you inform HMRC of the income and expenditure incurred in that period. It's just a matter of fact. What came in, what went out. You're updating them with that figure. It's not a return. Don't see it as a return. When it comes on to quarter 2, it's going to be cumulative. So we're updating effectively those quarter 1 figures with the following 3 months to have a 6-month period for the tax year so far, showing the fact that this income was received and this expenditure has been incurred. And this will go on through the tax year and be submitted by those deadlines. There is the option to have calendar quarter elections. So if you are sole trade or VAT registered and reporting to the quarter ends, you can elect to be the 1st of April to 30th of June, etc., ending on the 31st of March. So there is the option for that there. Once these are all completed and submitted, and you'll see on the screen now, I hope, that final quarter is submitted by the 7th of May, very early on in the year when we're used to that 31st of January deadline. And then we look towards the annual final declaration. Now, this annual final declaration or digital tax return, you'll see it referred to as numerous things online, is the closest thing you're now going to see to the self-assessment tax return that we know and apparently love, according to Andrew. So it's very similar. It's where everything is pulled together to work out your overall tax position for the year. It's really important to mention at this point that we've obviously, at the beginning of this, been discussing that you're brought in on your threshold income being that combined with sole trade and rental. However, when it comes to your quarterly updates, these are separate, as they would be in your sole trade, your self-employment tax return, where you're completing self-employment pages and rental pages. So if you have a sole trade business and a rental business, you will be submitting quarterly updates for each business throughout the year. So if you're sole trade and a landlord, that's effectively 8 quarterly submissions a year. These quarters are fixed, so they're all at the same time and deadlines, but just to acknowledge that it's not just combined at this stage. The annual final declaration, therefore, or this digital tax return, what will be the most familiar to everyone, is where we take those income and expenditure figures, those raw figures of what's happened, and we're going to apply any tax adjustments, allowances, relief. We're going to bring in your pay-as-you-earn employment income, add on any investment interest or dividends to work out your overall tax position, so calculate that tax liability. And that deadline remains unchanged, being the 31st of January. It's also really important to note that the tax point also remains unchanged. So the tax liability will still be due as normal by the 31st of January or 31st of July if you're in the payments on account regime. And at the moment, there's no talks that these 7th of the month's deadlines will also be the tax point. That's not to say that's not the end goal, but it's certainly not in the talks at the moment.
It should be noted that with the annual final declaration as well, with the revenue's new system, everything should pull through. So if you've done all your quarterly submissions and the pay-as-you-earn information is fed in directly via RTI, so it goes into the revenue system, when you come to that annual final declaration, everything that the revenue already have to hand should feed into that return. And it's a case of then, like Izzy said, investments, gains, reliefs, we need to consider bringing that in and any adjustments to those figures for the sole trade. Additionally,
we must add that this final declaration is not the self-assessment tax return. So once you're mandated into MTD, you have left self-assessment. They're a different system. They're not the same thing. This isn't your SATR, your SA100 that you know. It's a completely different return and it's going to look very different.
So we might be in the process there where we've got some clients that are doing MTD ITSA, who are doing these quarterly submissions and then this digital tax return or annual final declaration. Whereas we might have another client, let's say somebody has pension income, investment income, they don't have any rental, they don't have any sole trades, they do the normal tax return. So we've got two kind of regimes going side by side here, both with the filing deadline, the final filing deadline is 31st of January. One thing I notice here when I look at these dates is we've got the filing deadline 31st of January, but we've also got for the next period, I was going to point it here, I don't know if you can see it now, we got the Q3 being 7th of February deadline. So that's going to be a real crunch point where we're trying to get all the tax returns in for the existing regime or the annual final declarations for the Making Tax Digital ITSA regime, plus also the Q3 submissions as well. So, that date's going to be quite bad, I think, for most accountants. Izzy mentioned about if you've got a sole trade and you've got a rental business, having to do different streams, you've got to do different quarterly submissions. It should also be added if you've got two sole trades, you need to do two sets of quarterly submissions. And also if you've got back to this foreign rental business, that's a separate stream as well. So if you've got someone, let's say, having two sole trades, one UK rental business and one foreign rental business, non-UK rental business, let's say, then what you've got is 16 submissions every year because you're doing 4 for every one. You've got 4 streams. Penalties. So there will be penalties if these submissions are late. So the revenue moving more to a bit like the VAT system, a point-based system. So if you get one of these submissions, these updates, quarterly updates, they're late, then you get 1 penalty point effectively. And once you get to 4 penalty points, they're then going to start implementing monetary penalties, like £200, let's say. And those penalty points, a bit like driving license, will drop off after a period of time. I've seen 24 months. So it's good, obviously, getting them in on time, but you've got these penalty points. You don't want them to rack up because then that starts turning into penalties. The payments aren't changing at the moment. It's still 31st of January and 31st of July if you're in the payment on account regime. So these quarterly updates don't affect currently when you've got to pay the tax. You can pay it early if you want, but the deadline is still the same.
And with that point on payments, we've obviously mentioned that this is separate to self-assessments. You're in a new system when you go into MTD, but your payments are made to the same place. So these will still be seen on your personal tax account as usual. And that's all they've announced at the moment. Again, as the systems become more intelligent, and I'm sure this will advance, that might change. But at the moment, payments will be made as normal to self-assessment with we assume your UTR as your reference number. However, we'll get onto this in a minute with the registration process. You actually register for MTD with your NI number rather than a UTR. So HMRC does realise that, as we've mentioned, this is an enormous change and the biggest in 30 years. And they have published a few easements to try and help certain individuals. And we'll run through a few of these. There are others, but these might be relevant to a few of you listening. The first being the 3-line account easement. So this is going to be relevant for individuals with sole trade income and or rental property underneath that VAT threshold. So that VAT threshold at the moment is £90,000. We'll see if that changes again. We've got a budget coming up. But income and expenditure underneath that threshold, you can elect to use a 3-line account method. What this means is that you can record on your quarterly updates, your income and expenditure as one figure. You don't need to categorise out your expenditure. You can just say, I've had X amount of income, I've incurred X amount of expenditure to result in X profit, not tax adjusted. The only caveat there that if it's rental income and you've incurred mortgage interest expenses, these will need to be split out, obviously because they've got a different tax implication. And the other one there is for joint property owners. So if you own a property jointly, whether that be your spouse, friend, business partner, often in these circumstances, one of you is managing the bookkeeping. So you're not fully aware, if you're not that person, about what's being incurred throughout the year. So what they've said for joint property owners is that you need only report the income on the quarterly updates, and the expenditure then can be included at the year end when you've had time to have that conversation with that person and collate all of those figures. There is an easement there for you. And you'll see at the bottom there, there's the easement for if you're electing both of those, being that you have a joint residential property, or I take that back, a joint property with rental income, but also you've got other rental income, say under the VAT threshold. So you can elect to do just report your income for your joint property and use the 3-line account method for your other rental income.
Yeah, there are some, these easements affect the quarterly updates, but there are some other easements that have been introduced. For example, retail businesses, instead of having to list every single transaction that goes through the till, you could lump it all together into a daily takings figure when you're keeping your digital tax record. So there are some other points to also consider, but these are the main ones and how it affects the ones that you see on the screen there.
So evidently there's a lot to consider and it is a big change. So you may be thinking, what can I do to get ready? And we've got a little bit of time now before April 2025. 26, sorry, we've already passed that one. We've got a little bit of time now that we can put some things in place to get ready. The first being that online software. Now, we've already touched on it, but I will go into further detail here. Unlike self-assessment, so the current self-assessment tax return that you can log into your personal tax account on HMRC, input those figures and submit. You are not able to do that under MTD. So HMRC are not providing a software in which this can be done, which I'm sure will sound ridiculous to some. What they're asking is that you use software that has, it's on their agreed list. They've got a list of software that's been approved by HMRC that is compatible with MTD, that needs to be used to submit these quarterly updates and digital tax return. So you might be VAT registered and already using software. You might not be VAT registered and already using software. So the first thing, if that is you could consider is, does the software I use support MTD? And again, there's a list where you can check with HMRC for that. And how do I add that to my package? For some people, this is already included. Others, you need to add it on. So there's something to consider there. What we're not asking is every single taxpayer affected by MTD to get software, because we know it doesn't work for everyone. And as accountants and agents, we have our own software that is compatible with this system, that we can do these quarterly updates on your behalf, as we have been doing a self-assessment tax return for a number of years.
So I think on that point, it's a case of working out who's doing what.
Yes.
It's about the communication. Are you going to be doing the quarterly, or are our clients going to be doing them directly? Are we going to get the information, do it every quarter as well using our software? So it's that kind of management of who's doing what.
It might be that so far you've done everything paper, you've done everything with receipts, and you've pulled that all together yourself, ready to give to us to do your tax return. And doing that every 3 months feels like a task that you just don't have time for. So it might not be that you adopt online software, but it might be that you look to think, well, how could I use an Excel spreadsheet to aid me in this that I can send to my agent to get these submissions done? So lots to consider there, but again, just ask. If you're VAT registered, so you're already doing MTD for VAT, which you can consider, do your VAT quarters align with the tax year? Evidently in the VAT system, you can choose your quarters. And before the basis period reform, a lot of people had VAT quarters in line with a basis period that was relevant to them or was convenient for them. If your quarters do not align with those March, June, September, December quarters, we would really recommend that you bring them in line, because that's just going to make things a lot easier moving forward. Without doing so, you're effectively going to have 8 submissions for the same income and expenditure per year. So it's certainly something that we would recommend you do. It's really straightforward. You just have to inform HMRC that you want to change your VAT quarters. You do a slightly odd period for a different number of months, and then you'll be ready and waiting for April 2026.
And just to come on to, it was on the previous slide. So the Making Tax Digital is already set for, say, the 5th of every quarter. So you would also need to change those quarters to effectively the calendar months quarters, and you need to do that before the tax year. So if you're VAT registered and you're going to consider aligning your VAT return, let's say to March, June, September, and December, then you also need to tell the revenue before the tax year. Actually, I don't want the 5th of April. I want 31st of March. So it all ties in with the VAT records.
Then
I should say that's for sole traders only.
Yes, that is
change, not the
that
rentals.
is rental. It will always run to the tax year. Yep. Another thing you could consider doing, and a lot of people already have this in place, but not everyone, and that is absolutely fine, is consider setting up that separate bank account. A lot of people will be sole trade or rental owners, and all of that income and expenditure will move out of their current account. There's nothing wrong with this. It's completely fine. There's not a problem with it. But in terms of at the end of the year collating all the relevant income and expenditure, it does add an additional level to that sort of admin task, increasing the time taken, etc. So it might be worth considering getting a separate bank account set up to sort of ensure all that income and expenditure flows through. The banking apps now are brilliant, where we can download CSV files, which will put that income and expenditure straight into an Excel spreadsheet, which will definitely help in terms of determining what's come in and what's gone out, without necessarily the need for another piece of software. So that might be a really simple step you could take to separating this income and expenditure and reducing the admin at the end of every 3 months in terms of isolating what's relevant to go on that quarterly update.
Yeah, I think that's key, because some of my clients, they run through, you're looking through the year end, they'll give us the bank statements for the rental property, and you might have Tesco shops, personal expenditure in there. I think it's brought even more to light with Making Tax Digital, having to do this quarterly, that, just to simplify matters, put it all in one bank account, only using that bank account for that rental or that sole trade just makes life a little bit easier, really. I think it'll save the headache.
But additionally from that, we need to register. So this isn't something HMRC will automatically be doing. And if when we complete your 24-25 tax return, or you might be doing it yourself, and you know that you're over these threshold, that being the £50,000 in 24-25, like gross income of £50,000 for rental and sole trade income, you will need to be mandated from April 2026, and therefore you need to register. It's very simple. It's a really straightforward process. You just have to log in, register for Making Tax Digital, and they ask for your name, business details, and your NI number, as I mentioned, not your UTR number. So it's a slightly different link. But that needs to be done before April 2026. HMRC have sent out some letters, but they aren't actually registering you for you. So if it does apply to you, and if you're our client and we notice, you're over the threshold, we will take that into our own hands and inform you that we need to do this. But other than that, it's not something that happens automatically. And if you don't register and then miss the first quarter, you will incur that first penalty point.
Yeah, I think on that point, based on...
Hello, it's me again. Can I ask some questions? If there's any questions to start, let's get it, if that's okay.
Yeah, we can hear you.
Yeah, okay. So you said to have 3 consecutive years below the threshold.
Yeah.
Is that starting from like 25, 26, or is it backdated before then?
So I believe if you say 24, 25, in my example that I used, 24, 25, I have sole trade is high, and I know it's going to be low. I believe it's on, you've got then 25, 26, 26, 27, 27, 28 is under.
Yeah.
And at some point then you need to deregister, whether it's at the end of the third or, I don't know if you'd...
I appreciate the point probably there being that 25, 26 tax year, you won't be in MTD. So does that count? I believe it does. Because at the end of the day, it's still an income and expenditure reported to HMRC. So I do believe 25, 26 counts towards that 3 year. But that's certainly something that can be checked. The legislation is changing constantly on this.
Thank you.
Okay. So back to Izzy's point on the registration, I understand the revenue have sent out over 800,000 letters, they've said, based on the 23-24. So taking a step back here, saying, based on what was on your 23-24 return, I mean, that's not the one that brings them into MTD, but it's saying, we've had a look at your 23-24 return. We think you might be in Making Tax Digital if things stay similar going forward, just to give you a heads up, really. So a lot of you maybe watching this now have had that letter, that initial letter saying, MTD is coming. We believe it might be applicable to you. The plan is, I understand, in February, March 26, more letters are going to be sent out, because if you imagine 31st of January is the filing deadline for 24-25. That's the year that's looked at for the first year for Making Tax Digital. So for ITSA, so the revenue by February, March will have that tax return information on the system, and they'll churn out a load of letters saying, we've looked at 24-25. You need to be in MTD ITSA going forward. When 25-26, to reiterate Izzy's point, that's not, we've registered you for it. It's a case of you're in it. You need to register yourself. So that letter doesn't necessarily mean that you're registered. There's still some action to do, let's say. The other point to say is, if you haven't received a letter, let's say you've got sole trade income and you know your actual gross turnover is 100K and you haven't had a letter, don't think, oh, that means I don't have to do it. Letters could go AWOL in the post, or, something may have gone wrong somewhere. I think still, inquire, find out, why I haven't had a letter, but I should be in this regime, and take the steps to get you into that regime. I don't think, you can't say, oh, I didn't get a letter, because your criteria, you should be in the regime. I think that's that point. Any other comments on that slide? No, fine. And, that's the end of the slide. So hopefully that's provided an insight into the changes afoot, really, of what's going. We here at Bevan Buckland, we appreciate that it's not one size fits all for our clients. Some clients are going to do bits themselves. Some clients we might have to do the bit. So we're trying to look at our internal processes on how to best manage this going forward, really. We know it's coming April 26. and just trying to work out how best we could continue to service those clients. But hopefully this kind of webinar has given a bit of an overview of what's coming, a bit more of an understanding of the process that's involved, and and then we'll see how it goes. It's going to be teething issues at first, like with any revenue system that's implemented, and but we'll just have to watch the space and see how it goes. Is there any more questions? I know we've had one question already. If anyone's got any other questions, I don't know if they can say them verbally or if I get a message through from the main computer.
I have got another question.
Okay, yeah.
Drilling down on my previous point, I've got, I'm selling one of my properties. I have a rental business. I'm selling one of my properties before April 26.
Yeah.
Therefore, my income will go down below, let's say, 50,000 threshold. You were saying, you cease trading.
Yeah.
That's a different thing. But obviously, I'm ceasing trading on a portion of my business. How does that?
So, on that understanding, not to give too much away, I believe you've probably got other rental properties that you're going to continue.
Yes.
Yeah. So you've sold one property, but you've still effectively got a rental business. So in that, you would still stay in, and that 3 year, let's say your other rental income only generates £5,000 of rental, you'd still stay in for that 3 year period effectively until you drop out of that, make it tax digital. You're not ceasing your rental, you're just cutting off a part of that rental, but the rental is still continuing on the other properties. I don't know, Izzy, if you've got anything else?
Yeah, so I know we mentioned earlier sole trade, for example. You've got two sole trades, that's two sole trade businesses. If you've got foreign and UK rental property, that's two rental businesses. But if you've got a number of UK rental properties, that is one UK rental property business. So what's happening is your turnover will decrease in your rental property business, perhaps below that £50,000, but does it then reduce below the £30,000 and the £20,000 thresholds that are coming in? So evidently we talk about falling below these thresholds and being opted out or being able to remove yourself from the system. But if, as the thresholds come down with that, you do have to bear in mind, am I under that current threshold when considering that?
And also you might have, I don't know, circumstances, you might have sole trades and other bits that still keep you above, in addition to the rental. So every scenario, every fact pattern is different, whether each needs to be looked at in its own right, really, to work out whether you're in, whether you're out, how long until you do come out, and what the circumstances are. Does that help?
Thank you very much.
Good, no problem. Any other questions while we've been having that one? Any more coming through on Teams? Not that I can see. Okay. Well, I think that's all then. Hopefully that's been really helpful. By all means, if there's any questions, just ask. It's the system's coming in, so just ask if you've got any questions, and we'll get back to you and work out together. All right. Thank you all. Thank you for attending.